Hello and welcome. Thank you for joining us at the Reuion Seller Office Hours. We will start the session momentarily. In the meanwhile, we will be opening up a quick poll, so if you could please answer a few questions, that would be much appreciated. The poll will give us a better overview of who's here with us today. Hi and welcome. Thank you for joining us here today. We're just taking a minute or two to wait for folks to trickle in. In the meanwhile, if you could please answer a few poll questions, that would be great. We'd love to get to know you more. Welcome everybody who's joining us today. We're just going to start in a couple of minutes. If you could please answer the poll that has just popped up while you're waiting, that would be great. Hi and welcome. Thank you everybody who's joining us today for the Reuion Seller webinar. We are just going to start momentarily. If you could please fill in the poll if you haven't already, and we will get started shortly. All right. Well, good afternoon, or depending on your time zone, good morning. My name is Maria Verbeite, and I'll be producing today's webinar. So let's get started. On behalf of everyone at Reuion, I'd like to thank you for joining us for the second of our Seller Office Hours. We hold these hour-long sessions every quarter to equip you, our developer and manufacturer friends, with our latest market insights and answer whatever questions you may have. I'm joined today by Reuion's co-founders Andy Moon and Billy Lee, and our special guest, Phil Shapiro from Summit Ridge. Before handing it over to them for introductions, I'd like to walk through a few house-cleaning items. We are recording today's webinar, so folks who weren't able to join us live or for the whole hour can watch it later. We have disabled audio and chat for participants to minimize background noise. We would, however, welcome any and all questions. Please send them our way. We want to keep this session informal and interactive. You should see a Q&A button at the bottom of your screen. When you submit a question, which you can do so anonymously if you choose, Andy, Billy, Phil, and I will receive a notification. Although we may not answer a question in real time, we'll do our best to address as many of those as possible. And as your producer, I'm reserving the right to elevate fantastic questions while our panelists might be talking. If you experience connectivity or accessibility issues, please email me, Maria, and we will troubleshoot behind the scenes. I'm at maria@reuioninfra.com. Once again, thank you for joining us. And of course, thank you for all that you do to accelerate clean energy. Now, I'll turn it over to Andy to preview today's agenda.
Thanks, Maria, and thank you everybody for joining us today at the end of August. We're very excited to have Phil Shapiro with us here today to talk about his experience and sort of his outlook on the tax credit transfer market. We'll kick off today's session by running through a few slides on everybody's favorite topic, which is pricing and market trends. Reuion recently announced that we have facilitated $1.5 billion of tax credit transfers so far in 2024. So we've seen a lot of patterns start to emerge from both buyers and sellers on tax credit transfers. After that, we will dive into a panel discussion. We have a lot of great questions teed up, many from you in the audience that we'll run over with Billy and with Phil. And we will leave time for questions at the end. So if you have questions that come up during the presentation, please feel free to add them to the chat, and we will see all of them and try to answer as many as we can. So without further ado, we'll do some introductions. My name is Andy Moon, co-founder and CEO of Reuion. I have a long background in project finance and project development. And at Reuion, I do work very closely with many of our Fortune 500 tax credit buyers. Billy, I'll hand it over to you.
My name is Billy Lee. I am the president and co-founder of Reuion. I've been very closely involved in renewable energy finance, tax equity, and development for almost 20 years, and very excited to be here today and talk about tax credit transfers. Phil?
Well, thanks, Billy. Thanks, Andy. I'm Phil Shapiro, Vice President of Project Finance at Summit Ridge. I co-lead or lead all of our sponsor tax, construction, and term debt fundraising efforts across our C&I and community solar portfolio. Summit Ridge is a community solar focused developer based in Arlington, Virginia, with a focus in a handful of Midwest, Mid-Atlantic, and Northeast community solar markets.
Great. So I'll hand it over to Billy to talk about some of the trends that we're seeing on the deal front.
Yeah, I think there are four major trends that we wanted to summarize and talk to you about a little bit today, and we'll get into others as they come up. But first is that tax credit transfer activity has increased a lot in 2024. I think 2023 was a year of a lot of waiting around for guidance, and then trying to figure out what credits were available, and trying to dip. A lot of taxpayers were dipping their toes in thinking about tax credit transfers. 2024 was a year where tax directors, and many public and private companies across a lot of different industries were actively looking for and executing on tax credit transfers, which has really increased the amount of deals that we've seen in 2024. So we are starting to see that momentum really go very, very high. And we anecdotally say there's not a single tax director in the U.S. That hasn't heard about or perhaps is even exploring tax credit transfers. It is in everyone's playbook at this point. Secondly is, given our experience with a lot of deals, what we're finding is speed of execution is a critical factor in winning deals. So a lot of deals are competitive, where a developer or manufacturer has certain credits, and there are multiple buyers that are interested. And so what we've found is the buyers who have done their homework, who have figured out what they want to buy and figure out their approvals, are in pole position to acquire these credits. So as sellers, we constantly make the case that our buyers we try to prepare them and to get them ready for a transaction to maximize the certainty of execution. Third, I think the scope and coverage of negotiation is a real deal negotiation, and there's an interplay between insurance as well as indemnification and potentially parent guarantees. Early in the tax credit market, a lot of buyers were demanding tax credit policies that covered over 100% of the tax credit value. When I mean 100%, I'm talking about the limitation of liability. I think we're seeing a lot more flexibility in the structures where maybe insurance is not required to cover the full tax credit amount because there are other mitigants such as portfolio diversification or indemnities. We are seeing some creative interplay between indemnity and insurance, and also parent guarantees. So there is a fair amount of nuance there. It's not just whether there is or is not insurance. It is a multifaceted discussion. And then finally, buyers are increasingly interested in ITCs. I think there were a lot of folks early in the year or last year that just wanted to do 45 PTCs or 45X AMPCs. I think buyers are looking more and more at ITCs, especially since the year is now in the second half. ITCs that are generated in Q1 and Q2 are a little harder and more challenging for tax credit buyers because it requires them to come out of pocket relative to the payments that they are making over 4 quarters in estimated taxes to the IRS. But now that we're firmly in Q3, there's a lot more interest in ITCs, and also there's a relative, I think buyers are coming around that there is some good relative value to ITCs compared to some of the production credits. Next slide.
In terms of pricing, one pleasant surprise has just been how quickly very large taxpayers have mobilized in terms of being interested in buying tax credits. And as a result, that's actually resulted in a bit more competition for some of the larger credit opportunities. Your typical large taxpayer that's paying 500 million or $1 billion in annual taxes typically looks for a project that has some scale to it, multiple hundreds of millions. And as we know, there are pockets of supply and demand imbalance where it can be hard to find those large projects. And we've seen pricing creep up where there's a lot of competition for large credit opportunities. As we've moved on in 2024, we have seen some upward trending in pricing for across the board for ITCs, PTCs, and AMPCs. I think there's a dynamic where there are some buyers that may have bid on or issued term sheets for credit opportunities earlier, and maybe they didn't get the opportunity they wanted, and now they're really in a position where they want to lock in credits in time to offset Q3 or Q4 estimated tax payments. Now that said, I do think that there is a price ceiling, if you will, on ITC transactions. We do come across sellers that say they want mid-90s, 95 cents per credit for ITCs. And that's a tough sell to buyers because, the AMPC and PTC credits are trading in the mid-90s, and those are less complex than ITCs. And so, buyers do want to see some additional discount in exchange for entering into an ITC transaction. One ancillary price consideration is that buyer fee reimbursement has become more or less standard on many of the deals that we see. I'd say your average buyer is very sensitive to making sure that they don't incur above the line costs, transaction costs included, including professional service fees to lawyers or other firms. And as a result, we see in most term sheets, buyers requesting some sort of reimbursement for professional service and transaction fees. Next slide. So to recap on sort of how we look at pricing, it's remained fairly consistent in so far as current year production tax credits are trading at the smallest discount. Those tend to command a price of 93 to 95 cents for the seller of the credit. Now, if the contract is multi-year, or if it's a forward PTC contract, then those will trade at a larger discount. After that is de-risked ITCs, so ITCs that have some volume and typically will have tax credit insurance or an indemnity from a creditworthy guarantor. Those typically will land in the low 90s net pricing to the seller. And this is after the cost of insurance, after the cost of transaction fees. More complex ITCs will land in the high 80s. So these tend to be technologies that have lower buyer demand, such as biogas or smaller transactions. And I think there's a very long tail of uninsured ITCs that can trade at various pricing levels. Great. Okay, well, with that, we will move on to the panel discussion portion of our conversation. Why don't I kick it off with a question for Phil? So Phil, I know you've done tax equity, joint ventures, cash partnerships, and you've done now a few transfers. How do you think about what the role that tax credit transfers will play on your projects going forward?
Yeah. So I think we as a developer are very kind of oriented around legacy transaction structures, and all of our KPIs are essentially pre-tax cash driven. I think a lot of companies like ourselves are kind of oriented similarly, where they're very used to focusing on optimizing pre-tax cash in the realm of a partnership flip tax equity structure. As we've seen the possibility of transfers and the entrance of all the new players that groups like Reuion are bringing to the market, I think there's a trade-off that we have to kind of balance in pivoting away from those KPIs and those metrics in terms of evaluating proposals and kind of the seemingly faster transaction speed that transfer buyers can offer as compared to kind of partnership structures. So I think there's a role for it, particularly as we consider our tax liability as a developer that's now 7 years old. We're taxable, we've been profitable for a while. And kind of balancing that with the desire to kind of optimize the pre-tax cash attributes of the project, where maybe selling the depreciation to a partnership investor isn't the right answer by itself. So I think for us, it's highly likely that we continue to use tax equity structures to some degree. But transfers obviously going from 0% of our pipeline 2 or 3 years ago to now today will take a much more meaningful chunk of what we're doing as we work forward.
Are there any patterns in terms of the types of projects that you might be more inclined to transfer versus enter into a tax equity partnership?
I think we're always balancing project schedules against commitment timing. And I don't think it's unique to tax equity or transfers in terms of who's willing to commit to what part of the forward commitment. That's where we've seen the biggest sensitivity on our side, though, is which type of investor is focusing on the next set of projects that are going to go into construction. So we've got a handful of assets that will go into construction in the next couple of months that'll reach place in service at the end of 25 and the early part of 26. And that's a unique sell for some buyers that are just now turning away from 2024, both on the partnership and the transfer side. So that's kind of how we've balanced it. I think our projects are similar enough across the board, about for scale and kind of some market dependencies, where it's not as though we're planning to say, all of our Maryland projects are transfers, for example. It's more timelines and groupings of projects that you will respond to the market with.
Yeah, that's a common refrain. Definitely, the timeline and when you can fit a project into an existing tax equity partnership or commitment plays a big role in whether that moves in that direction. Billy, maybe you can provide some comments on the types of patterns we're seeing in terms of the types of developers or the types of profiles of seller that are looking to transfer.
You're on mute, Billy.
This has been really exciting for us because the diversity of sellers, whether they're project developers or manufacturers, have been pretty vast. So we've done your traditional solar, wind, storage, ITCs, and PTCs. We've been lucky to do credits from other technologies such as fuel cells, biomass projects, and a number of different 45X eligible components. And for those that don't know, these are things like modules or wind components or inverters or torque tubes, things like that. Any type of domestic manufacturing gets a credit. So in the value chain, there is both a credit for manufacturing and a credit ultimately for the project itself. We actually just closed on our first 30C charging infrastructure credit, so that's been exciting. So I mean, and beyond the technology, I think we've seen sellers that are very large and investment grade and publicly traded, and we've seen sellers that are basically a couple of folks that are just running a side business or just running their own personal thing, and everyone in between. So I think you're seeing kind of the intent of Congress in creating transfer kind of really play out. So that's been pretty exciting. Maybe at this time, like I'll address one of the questions that came up. What about sponsors who have strong ESG/DEI credentials? What about them? Are there premiums for those projects? I would say that it's been interesting. Our initial hypothesis was that a lot of tax credit buyers would want some nexus to ESG, REX, DEI, some sort of ancillary benefit. I would say that by and large, there are some tax credit buyers that want the story to be a part of it, but by and large, I think most folks are viewing this very simply as a financial investment, albeit one that uses tax liability. So for every taxpayer that values some of the qualitative benefits, there's probably 9 that just are looking at the merits of risk versus reward.
And Billy, let me touch on very large developers for a moment. I think when we started, in 2023, there was some initial feedback from very large developers that said, "Hey, I've got tax equity lined up. I'm good. I don't need to do a transfer." How is that market, or how has that changed over the last year?
I would say there's a lot more. All of the above type of approach, similar to kind of what Phil, you were saying. It's like we'll do tax equity, we'll do transfers. We'll have different use cases for both. I would say that tax equity and tax credit transfers are definitely not mutually exclusive, and in most cases, I think if you are doing a tax equity deal, there will be a transfer component included. If not explicitly done, there will be some flexibility for either the sponsor or the tax equity partner to effect a transfer. So I think there's also a lot of developers who 12 months ago were saying, "I'm just going to do tax equity. It's better. It's more creative." And then over time, they realize transfers are a lot less burdensome, and with all things being equal, may not be as accretive on paper. They are so much less burdensome from a resource standpoint that it just allows these companies to do a lot more and faster. So that is a critical evaluation. A non-quantitative evaluation is how much burden do these structures take just from a deal standpoint.
Let's change gears and talk a little bit about some of the challenges from the developer perspective. So one that comes up frequently is there is often a mismatch in timing between when a seller wants to get paid and when a buyer wants to commit. So for example, we have a lot of developers approaching us saying, "I want to find a buyer that can commit to a tax credit purchase for credits that will be generated by my project in 2026. And of course, the reason they want that commitment is to use that to get a bridge loan. In general, I think the lending market has not materialized as fast as we might have expected. And Phil, I'd love to get your thoughts on where's the tax credit bridge lending market today, and where do you think that might move towards?
Yeah, I think it hasn't moved a whole lot since prior to the transferability provisions, which that's one of the pieces of the legislation, or the market response to the legislation, that I think is more surprising to us. I think the non-bank lenders that were comfortable lending against term sheets or no tax equity commitments continue to be comfortable with that risk, and the banks that required creditworthy commitments to backstop their lending obligations still think that way. I don't think I think there are a few groups that are lending against kind of hypothetical transfer proceeds with extremely low proceeds, such that it's not really, it wasn't workable when we explored those products. So what you described is kind of one of our bigger problems that we face as developers, always kind of having that commitment well ahead of the project place and service timing, for the exact reason you mentioned, the sourcing our bridge lending and advancing the project such that the credit becomes real on the schedule we want it to be.
Yeah, and I would just add from the tax credit buyer standpoint, A lot of these tax credit or tax payers, corporate taxpayers, their tax directors really have kind of a very limited field of vision. So they are really focused on this year's tax liability and maybe starting to think about next year's tax liability. But when they're thinking about 2026, it becomes a lot more challenging for them because number one, they are taking risk that ultimately they won't have that tax liability when all is said and done because of some changes in their core business or really importantly, change in law, right? There are changes in law that happen with tax and that could kind of really impact a company's tax liability. So I agree with you, Phil. It is a pretty big conundrum because I don't see huge changes in the way tax directors will act, given that they are generally pretty conservative. And the folks that are doing long-term forward commitments are typically the banks and insurance companies that have gotten comfortable with tax equity anyways. And the lenders really are that critical piece in the middle, right? Where a bridge product that doesn't require, a committed offtake is really kind of something that's missing because, of all the lenders that are willing to do, what's called naked bridges, I think we're hearing that they're at best providing 70% advance rates against 90-cent purchase price assumption. So you're landing kind of in the mid 60s advance rate for the tax credit portion. And that's a lot of equity for a developer, even as, substantial and established as Summit Ridge. Is that am I characterizing that correctly?
Yeah, I think you are. The piece I'd add is we do math all the time around accepting lower price per credit to go further out because of kind of how explicit that cost is on the lending side, where we can quantify 90 cents for 26 is better than 92 and waiting 2 years, right? That's the math we do very frequently on our team.
Yeah, absolutely. We are getting a lot of questions on basis step-ups, which actually is one of the next topics. And so why don't I ask I'll this one over to Phil. Questions around how are sellers, what structures are they using to achieve a step-up in cost basis for purposes of ITC? Maybe you could talk a little bit about the market in general, as well as kind of strategies that you've looked at.
I think there are a million strategies that we hear of kind of from a lot of different players in the market. Our core structure as a company is really oriented around equity joint ventures. The premise of those joint ventures is for the JV partner to pay us a fee. That is the premise of the structure, and to take effectively a preferred equity shape. I know some other folks have tried to replicate that on the Class A side of things, but for us at least, that by itself is essentially enough to get to a step, to get to the dev fee and basis numbers that we want to for claiming the ITC. I know some other folks have structured or attempted to structure things that look like tax equity to me. They're some form of a Class A investment, some form of a partnership investment that's sinks around for the recapture period. A lot of those options I've seen are relatively rich and cash intensive, which is at odds with some of the group, our structure generally, where we want to sell as much cash to our equity partner at a relatively low cost of capital. So that's kind of the push and pull there. In our view, it negates a lot of the purpose of the transfer itself if you're forced to go out and form a partnership anyway. That's expensive and complicated and diligence heavy. So there's a huge spectrum of stuff out there I've seen. I know one of the other questions that came across was around limitations of step up in F&V, and it's so structural dependent. We finance deals across the spectrum of that, and I think the guidance we've always received is that income and F&V calcs are the governor, and the express purpose of the IRA and particularly the ITC adders is to make these projects more lucrative for developers, and that the way that that happens is by making the income more valuable from making the ITC higher. And we don't have a number that's 20% or some number that folks gravitate towards that we orient to. It's more, can we get comfortable with the income approach? And then does the structure support it?
Yeah, there's an interesting question in the Q&A as well about sort of, is there a difference if you're developing a project and creating value versus buying a late stage project from a third party to sort of get that step up? Any thoughts on whether that's viewed differently by other parties in the market?
I don't think there is a market consensus on this at all. Our view as a company, we do a lot of M&A, as you guys know. Our view as a company is that if we develop two projects in Illinois, one that we bought from someone, one that we acquired, or one that we do ourselves, otherwise identical, our view and our appraisal's view is there's nothing different about those projects. They should be eligible for the same basis, regardless of how they were sourced. There are some transfer buyers and tax equity players out there that look at those two projects identical and say that fee is too high on the one that you developed yourself, can't get comfortable. And that's a challenge that some groups work with. I don't think they're relying on a specific segment of code or a response to anything in particular from the IRS when they make that determination. It's more just a gut check on their side. But every project we've financed so far has been on the basis that those two projects are equal.
Yep.
And
Yeah, I would say
a couple of years into a handful of our projects from place and service without any audits, any challenges. So whatever that's worth.
Yeah, I would say that that is kind of the $1 million question is, are those two type of projects the same in the lens of the IRS, right? Because I think part of what you're saying is like, are they just going to do cost plus no matter what? Like, is the IRS just going to look at how much did it cost to build and forget about how you get to the final cost basis? Like, what is the differential between your eligible basis claimed and how much it costs to build? You can make a very convincing argument that I used to make in the 1603 days that, hey, listen, if I bought that from somebody else, that's a third party sale, and like there's no even if there's no affiliate aspect to it, it's like it's as third party as arm's length as you get. So why does it matter what somebody else paid for it? All it matters is what I pay for it. That's my cost basis. I think there's just rumbling in the industry and worry that the IRS is just not going to look at it that way. And I think that there is some legitimate pushback that, hey, listen, we don't want to expose ourselves to that risk, whether or not it has merit or not. And I think that uncertainty, I think, is fueling all this kind of angst within the community, because I think what we found in practice is what tax directors and companies don't want is uncertainty, right? They don't want, even if they're completely covered by insurance or an indemnity or both, the hassle of going through an audit, getting an indemnity payment. Nobody's doing this to fund into an indemnity. So I think, we have heard that there are people in the industry are asking the IRS to create some sort of safe harbor. I'm not sure if that would be, viewed positively or negatively by the development community, but that certainly would create some better certainty. Whether or not they do that is who knows. And then just going back to the structure point, I think from what we're seeing, there are a lot of different preferred equity, Class A, quasi tax equity structures that are emerging, right? From basically any large infrastructure fund once again to this area, because now it's they're able to play in tax equity without having tax liability and put money to work, has a pretty good IRR MOIC profile. But again, like I think we've seen structures that, we're not tax attorneys, but some seem more aggressive than others. Some seem less aggressive. But yeah, it'll be a very fascinating area of evolution for the market. And as you know, sometimes I wonder, is the juice worth the squeeze for some of these deals? Because you are basically doing a tax equity light deal, right? You are negotiating partnership, which is not for the faint of heart. It does take some time, does require some expense, and there are still some uncertain tax positions.
Yeah, great points. Let's flip our attention to tax credit insurance. Phil, I'd love your perspective. As a developer, are you assuming that going forward you will have to provide tax credit insurance when you enter into transfers?
That certainly seems like the market preference. I think going back a year and a half ago, I don't know that we would have expected that to be status quo, but that certainly feels like where it's trended. As a matter of kind of corporate risk management, we were ordinarily getting some level of ITC insurance on every deal, and this is just anytime we were offering our guarantee, I should say. So the transfer requirements seemingly push that up modestly for us. And it certainly feels like an easier way to market the assets to kind of homogenize with the broad market preference. We are kind of harping back to something Billy was saying. I think the insurers are seeing kind of more of the market than any of us. And I don't know that they are materially changing the premium amounts in response to things that we're describing as kind of incremental risk points. So, we don't see a big change in insurance costs between project one, project two in the example we were talking about. So, the insurance market seems deep and very relatively liquid for these projects and relatively low cost. So it seems to be a nice way to kind of check a lot of boxes with prospective buyers.
And insurance markets are covering bonus credit adders and prevailing wage as well. Can you talk a little bit about your experience getting insurance on those pieces? Has it been difficult? Has it been burdensome? What's that process been like?
No, it hasn't been difficult, frankly. We've now financed every one of the adders, the low income, well, every one of the adders that's in our business. So the low income 20% adder, the domestic content adder, and energy communities for a wide range of reasons. And the insurance market, seems to look at the facts and circumstances of any adder in the same way that kind of a typical tax equity or a transfer buyer might look at those things. But seemingly they are willing to insure kind of all of those points.
Yeah, I would echo that. I mean, I think our experience with tax credit insurance has been generally pretty positive. I mean, obviously, it costs more than anyone wants to pay, but the underwriting has been fairly modest or reasonable, let's call it that. At the outset of this market, I was worried that tax credit insurers and their underwriters would basically replace project finance lenders as kind of the high bar in terms of diligence. And I think they've been pretty reasonable about understanding that not every issue has a 20-page memo and corresponding exhibits attached to it. So I think, and also insurance is fairly quick. We haven't had a deal where everyone's ready to close except for insurance. Typically, there's the buyer and seller are the ones that either one are the slow guys in the deal. So I think that's been helpful. I think from a buyer's perspective, yeah, insurance provides one real risk mitigation. I think especially for ITCs, obviously the basis is kind of the primary area that people think the IRS is going to go after, but it's typically a 20% issue or a 30% issue. Recapture is in some ways more scary, right? It's very low probability, but high consequence, but that consequence is there. So I think insurance will continue to play a role. Hopefully, again, we can make things more efficient by bundling projects, and just creating, just trying to make the policies tighter. So, yeah, I think it's been, and I agree, it's currently a pretty deep market.
Yep. And Billy, since we have a lot of sellers on the call, can you help give a perspective on how buyers are looking at due diligence? How much, how detailed are these buyers going on due diligence?
Yeah, I mean, I think we have a pretty good playbook at this point about what we ask for and what we provide to a buyer. We typically, for our larger projects, put together a due diligence memorandum that takes a lot of weight and a lot of burden off of a seller. So we typically have a diligence request list, and we'll ask, your standard things, and we'll synthesize it. And a lot of the work we've done is to focus buyers before we even get to the term sheet stage on, what areas of diligence matter, right? Do you need a full-blown IE report? Probably not, right? Do you need to look at the interconnection agreement to make sure that you have rights to interconnect for the recapture period? Yes, but that's pretty quick. So there's things like that where we spend a lot of time. We focus them on the really critical areas of really understanding, what a cost seg says, when you need an appraisal. So I would say that, by and large, we've tried to create a method and a streamlined process for due diligence. That being said, the larger the tax credit buyer, I would say the more diligence they want. And I would say that is especially true for the very largest taxpayers, who it's not a matter of when they'll be audited, it's a matter of if they'll be audited. A lot of these buyers are basically under constant IRS audit. So they have a team of IRS agents at their office that are just, looking through the books as would EY or Deloitte or whoever is auditing their books. And for them, I think the bar is higher because they want to be audit ready. They want to have every single piece of documentation that they could think of that the IRS would want and ready at their fingertips to provide. They don't want to, wait for a seller to produce that on their time frame. So I would say that's the one area where, we're still doing a pretty deep dive and doing a lot of work. But those are really big deals. Those are, some of the larger deals in the market.
And Phil, as you think about, taking your next set of projects out to market for transfer, what are the most difficult parts of information to collect for diligence?
I don't know that all of our projects go through a handful of financings before they get to the transfer. So, we've often qualified them for development facilities. We've qualified them into a construction debt facility. Our equity partners invested in them as well. So it's not as though the diligence doesn't exist for us.
Sure.
Our struggle is always one of the primary justifications of a transfer commitment is not having to do the diligence and not having to do all the stuff that goes with the project. So none of it are things that we characterize as hard. They're just annoying and time consuming. So, our golden standard for a transfer would be, here's the IE report that talks about everything. Here's the cost seg that financially summarizes it. And here's a PTO letter. Please pay us, right? That's the threshold we want to work towards. And every group that we've ever dealt with has some other thing that they're sensitive to, likely in response to whatever they've gotten hit with in the past, whether it's, an audit ready question or something else. So, we always have to balance that in terms of, if we're signing this commitment, it's because we think it's easy. If it's not, what are we doing, right? What are the other reasons? This is well.
Yeah, and for 2025, I guess, Phil, how long are you budgeting? How much time are you budgeting the transfer to take?
To go from identified buyer to commitment?
Yeah, that's right.
It really depends on the group and kind of the nature of the project, what we need. But I think the fastest groups that we've dealt with can go in about 2 months from, inbound interests to signed commitment. That's on the faster end, I think. ideally the market trends towards more homogeneous transfer agreements, and that can be brought in. Because I think tax equity at its fastest on a repeat deal is about that same schedule. Probably longer for new groups. So I think one of transfer's primary advantages is, it should be able to go a lot faster than tax equity, and when it takes about as long, it negates another one of the benefits.
Yeah, I think that's a lot of our focus is trying to get these buyers, which are very diverse, and many of them have never done energy investments before, really getting them prepared so they know exactly what they're buying, making sure that all the internal stakeholders have agreed and are ready to go before engaging with the sellers. But Billy, maybe you could provide some color on what we've seen in terms of timing of getting a deal done and what makes some deals more complicated than others.
Yeah, absolutely. I mean, I think certainly kind of maybe some of the more sophisticated buyers, right, are view this a little bit like project finance or tax equity and might ask questions that we normally would not think are that relevant. But I agree with you. I mean, I think there are some critical aspects of diligence. One good thing is like the things that in my old project finance tax equity days is like getting third party approvals, estoppels, consents, like all of that is typically not in the cards, and that's really what caused lots of problems and delays. But yeah, I mean, I think some buyers are ready to go, and we close deals in 2 weeks, and some take months. I would say a lot of times that we have extended delays, it's because of the seller's not ready, right? So that they haven't had started the cost seg, or it happened like once we learned very late in the day that it was actually it was a repower and they hadn't done a 80/20 valuation. There are certain things that really slow things down that are in the control of a developer, because I think they're hoping that they don't have to do it and they go down the route. And so it's also we spend a lot of time preparing the buyer, but we also don't talk about how much time we spend with the seller and getting things right. Sometimes cost segs take 2 months to do. So that's part of the dialogue here. Yeah, I mean, I think for sellers to, the best practice is to get everything ready. As you would, a lot of these sellers are doing financing anyways. And if you're doing financing, you typically have everything you need to do a tax credit transfer. There should typically not be anything more other than, maybe a cost seg that you would need to do for a tax credit transfer than a typical PF deal.
Yeah, and we've got one question from an audience member asking about when should sellers go to market if they want to sell a tax credit? Should it be before, at, or subsequent to PTO? Should the cost seg memo be prepared and signed or not? Maybe Phil, you could provide some thoughts on how you think about when you go to market with the tax credit transfer.
So I think the best pricing that you'd receive based on kind of my read of the market, and again, I'm not a lender, but the best pricing you'd receive is probably after PTO. That said, if you've gotten to after PTO and you haven't financed your ITC, you have now excluded a handful of potential financing options. I don't. For any project we do, we consider tax equity versus transfer. So we would never let ourselves get to PTO without knowing the financing structure that we're going to use, because then half of the potential avenues are closed to us. For us, the goal is always to sign that commitment ahead of the financing needs. So depending on our lender, that means we have to have a bound commitment when we want to start construction, or sometimes ahead of that to close into the construction facility. In some cases, we have lenders that are more flexible and look to, I think Billy called it like a naked commitment, effectively lend against something. And that's ordinarily non-bank lenders that we're comfortable with the risk before. And that gives us more flexibility to kind of wait and hope and let the pricing continue to go up as you get closer to spot credit. So it really depends on kind of what we're trying to do with the balance of the capital stack.
Yep.
Andy, there's a couple questions in here. Maybe we should, in the last 10 minutes, try to tick off as many of these as possible, and maybe I'll choose one.
Sure.
Many BESS projects will have ongoing CapEx for augmentation units throughout the life of the project in order to maintain capacity of the system. Are you seeing a value in these smaller expenditures for transfers, even though the credit size will be much smaller? Opportunities for bundling, question mark. I think there's two areas that I would focus on. One is just a lot of times, the credit generated is, if it's 5 million in one year or 10 million in the other, I mean, that's what a tax credit buyer will want to purchase. And so we have done kind of co-located batteries where we are selling the battery credits and that are co-located on an existing wind farm. So I don't think by virtue of being attached to a different facility, that's necessarily an issue. I would make the note that in the November guidance, the IRS came out with some pretty strange proposed regulations on retrofit ITC property, which would subject some retrofits to the 80-20 repower type rule. So I would just look at that very closely with tax counsel because for the last 20 years or whatever, you could just keep adding new energy property and create new ITCs. It looks like the IRS or Treasury wants to create some more restrictions around that. Those rules are not finalized, but they are proposed, but they would have potentially an impact in your scenario there.
Yep. We've got one other question. It says, does the presence or absence of project level debt at PTO impact seller offers?
That's a great question. I would say yes. Project level debt is one of the first things that we look at from a risk standpoint, because to the extent that there is project level debt and there is a default of the borrower that causes a foreclosure of the asset, then that could cause a recapture. So in the absence of any other risk mitigants, basically you're asking the tax credit buyer to assume financing risk. Now, there's really the cleanest way to deal with that is to ask the lender for forbearance, which would obligate the lender not to recapture in the first 5 years. And again, this is one area I've been actually pleasantly surprised and proud of the industry. Like I find that most lenders are generally willing to do this now, especially if you ask for it when you are in the debt term sheet phase, right? Before closing. And even if you don't have any expectations to do a tax credit transfer when you're raising debt, you should ask for it because you might get it and that increases your flexibility. Without that, it becomes very hard to sell. You might get less payments. You're gonna have to look at indemnities from a parent guarantee. Insurance hasn't been that willing to cover foreclosure risk. So this is a very good point and a nuanced point.
Yeah, the only thing I'd add is it's somewhat a question of when the tax credit transfer buyer is paying, whether that's actually a problem for the buyer. A lot of our projects carry construction debt that sits at the project level until substantial completion. That's ordinarily around the time when we're having our transfer buyers pay anyway. So we, even in the absence of forbearance, we're essentially not asking our transfer buyers to take that risk. We're kind of just saying, pay us 2 weeks later than you otherwise would have, and problem goes away when the debt converts up to back leverage.
Right. Yeah, and that's a good point because your term debt is back levered, which means if there is a borrower default where the lender exercises remedies, they're really only taking control. They're only foreclosing on typically your 1% interest. So the recapture is limited to a very small amount.
And it's a seller recapture event anyway.
That's
right. Not a buyer recapture. So it's
a couple other rapid fire questions. We have a few questions on payments. Are you seeing buyer payments come in lump sum, sequential payments, or others? How do they time with respect to the tax year of the seller? I'll address that second point quickly. If the seller or the buyer is on a fiscal year, that does create some complications in terms of when you can take the credit. So for example, we have a number of fiscal year buyers where their fiscal year ends, call it in March or April, they need to, if the seller's a calendar year taxpayer, then projects placed in service in 2024 would apply to the fiscal 2025, ending in, call it April 2025 for the buyer. So that's an important consideration. In terms of whether the buyer payments come in lump sum or sequential payments, typically with ITCs, we're seeing those paid more or less in full with the closing. PTCs are typically paid quarterly in arrears. Code Billy.
Yeah, I think there's some questions here about project size, and that's a great one. I mean, it is true that these deals still have some fixed costs associated with them, whether they're just plain vanilla transaction costs or where there are underwriting premiums that you have to pay the insurer and their counsel. So there is no min value or smallest credit. We've actually done credits less than $1 million. In general, the production credits are easier to do at small volumes. So we have done some smaller ITCs. I would just say that there is, if you have a smaller volume of credits, you should expect a wider discount, right? I think where the conversation stops pretty quickly is if sellers have $1 million credit and they want 90 cents. Really, that's only generating $100,000 of income to a buyer, and especially for small companies, that's just not that interesting. So this market is evolving. We are getting smaller and smaller deals and doing them at greater velocity, but there's an evolution, and market participants need to be flexible.
As we reach the top of the hour, well, there's one fun question here for Phil, which is, do you have any advice for other sellers that might be looking to do a tax credit transfer?
Solve for the structure before you go down the path. That is the piece that I think trips up folks the most, and make sure the structure works with whatever basis claim you attempt to make. Yeah, it's not vanilla. I don't think the whole industry is coalesced around a single structure where it's a partnership flip, so you're good in the same way that we were a couple of years ago.
Yep, that's great advice. All right, well, I think we're almost at the top of the hour here, so thank you all for joining today's webinar. We've enjoyed having the conversation with Phil. Thank you so much, Phil, for joining us today. We will do this on a quarterly basis, so stay tuned for our final quarterly Seller Office Hours webinar that will happen later this year. And if you have any questions in the meanwhile, please reach out to us or to Phil. Thank you so much.
Thanks very much.
Andy. Appreciate you hosting.